Hello class, this is a review of the homework problems for deferred taxes for this week and how that might look in an Excel spreadsheet. So this is our problem. We've got $462,000, we've got some municipal bond interest, life insurance premiums, we've got allowance for bad debts, and we've got some unearned rent, a second year of unearned rent. And remember, this is a continuation of what you did in practice. Exercise 1 and 2. This is the third year of the Wicked Incorporated tax situation. So going to our Excel spreadsheet, we start with our income before taxes. We adjust for municipal interest and life insurance. We do our allowance for bad debts. This is what we ended up the year before. This is our new estimate based on the 2.5% of accounts receivable. This is our write-offs. This is the difference between those two. Remember, the estimate is on the income statement, the write-offs are on the tax return. In this case, the write-offs were higher. Occasionally that can happen than our estimate. And so this is actually a negative because we actually have more on the tax return than we do on the income statement. Unearned revenue, we had the 26,500, we had 11 from last year that is now recorded in the income statement, so the difference is 15,500. Looking at depreciation, remember for tax depreciation we depreciate everything all up front, and so there's no depreciation on the tax return for 2018 for our assets we've considered. We bought no new ones, but the depreciation on our income statement would be $10,223. So the difference, if we is an addition to the tax return, because there's no depreciation on it. So we adjusted the tax return. So the taxable income would be $471,198. All right. Here's a T account for that unearned rent if you needed to visualize that. This was the unearned rent from last year. This is earned, and then this is the new amount of received as unearned rent. Once you have your taxable income, you get your tax expense current and taxes payable by multiplying by 21%. You look at each of your items. You skip the permanent differences, go to the bad debts. You look at the cumulative amount of the allowance. You figure out the tax asset is 21% of that, and then you compare it to the year before and adjust accordingly. The deferred tax asset needs to come down, and so that's a credit to the deferred tax asset. For 541 debit, tax expense. Everything affects tax expense. And then the unearned revenue, our cumulative amount is 26.5, so we should have a tax asset of 55.65. Look at last year's, it was less than that, so we debit the tax asset to bring it up to this number. We credit the tax expense. And then we talk about our depreciation, cumulative difference in depreciation. With total depreciation for tax purposes so far over the 3 years, 68,685, and on the income statement 24. So your cumulative difference is 44,582. That means our liability should be 93,62, 21% of that. And our old one was higher than that, so we're going to debit the liability. So we've got all of our journal entries. That means our total tax expense with all four journal entries, 94,094. So we have income before taxes, our tax expense, and then we have the net income. And then our reconciliation of the statutory tax rate to the effective tax rate. With this tax expense divided by the income before taxes, that's the effective tax rate. Municipal interest made this much difference, life insurance that much, and so we end up with a 21% or 97,000. The last piece here if we go down to problem 2, we have a really bad year. We lose lots of money. We have a lot of bad debts, as usually goes along with that. So as we saw, there was a big problem in the 4th year, or problem 2, with an NOL, a net operating loss, for the current year. And you might be tempted to think we do things differently, but it really operates in the same way as we did in previous years. We still take our income statement, our loss before taxes, all right, and we make our adjustments for bad debts. Here's our allowance. This is what it was from last year. This is what we were told to you as far as the transactions, and we end up with an ending balance of $28,490, which is $5,865 higher than it was last year, the allowance, meaning that we had the difference between our write-offs and our estimate. Write-offs here, estimate here is $58,65. The unearned revenue is earned, and there's no new unearned revenue, so all of that needs to be on the tax return, taken off the tax return, because we already paid taxes on it in the year earlier when we received the cash. And then depreciation is just one more year. Remember, for tax purposes, we took bonus and Section 179, so that there is no depreciation for tax purposes, and our book is $10,223 each year. So far, our total tax depreciation for books, our accumulated, is 34. Total for tax is 68, and so the difference now is 34. Up over the years, each year this is going to go up until these two are the same. Ultimate situation is that tax and books will be the same as long as you don't buy new assets. And in this year, we didn't buy any new assets because we were having so much financial problems. And so our NOL is actually not the same as what's on the income statement based on these temporary differences. We figure out, just like we did before, we take the taxable income, in this case, the taxable loss or net operating loss, multiply it by the tax rate. We make a journal entry, this time to tax benefit instead of tax expense, and we create a deferred tax asset for that amount that is going to go carry forward. Now, in the past, we would have used some of that to go backwards and get a refund, but that is no longer available under the new tax law, and so there is no carry back, there's only carry forward. So this represents the carry forward, or the future benefit of this NOL going forward. And then we have to adjust our deferred tax assets and liabilities the same way. Now, you can have this, this is on the balance sheet, this deferred tax asset and this tax asset will be the same. You will see the same account. In real life, you're going to track them separately, because this is a special deferred tax asset for the NOL, and certainly I would build a spreadsheet that would keep them separate, just like we've done with the other tax assets and liabilities, each separately. But on the balance sheet, you're going to see one line item for deferred taxes, asset or liability, and it's always non-current. So here's our change in the deferred tax asset. This is our new one. This is our cumulative difference to the allowance, new deferred tax asset, and this is the difference. It went up from last year by $1,232. Then that means if we debit the deferred tax asset, we credit the tax benefit. Depreciation is going to go the other way. We're going to debit the tax liability because our new cumulative difference is here. Tax rate multiplied by the tax rate here. deferred tax liability is going to go down. So we debit the liability and we credit tax benefit or tax expense, however you want to describe that. So our total tax benefit is going to be $247,065. So our loss on the income statement, $1150, tax benefit. So the actual net loss, so notice how this actually reduces the loss, meaning we have less of a loss because we're getting a tax benefit, these future deductible amounts. We don't get the benefit of them cash-wise until in the future, but we're recognizing that benefit now because of that loss. And because there were no permanent differences, all of our permanent difference items went away for this year, our effective tax rate is exactly the enacted tax rate of 21%.